there is an indicator that shows you the most likely stock market movements. Which one it is and how to read it, you'll learn in this video. Do you know why so many people fail in the stock market? Because investors do what the majority does. But the stock market can only function if the majority is usually wrong. Otherwise, anyone could become rich effortlessly. If you don't make the same mistakes as the majority, then you won't fail in any financial market. If you bet against the majority, you can even be very successful. On this channel, I show you what the majority is doing wrong. I show you how to prevent yourself from being part of that and how to take advantage of others' mistakes. But important, this channel is not investment advice. I don't have a crystal ball that tells me what the right investment will be in the future. Foolproof tips always come only from scammers. Subscribe to this channel and activate the notification bell. If an opportunity arises in the stock market to bet against others, I will publish ad hoc videos you don't want to miss. It is a well-known phenomenon that the stock market generally trends upward over time, leading investors to sometimes underestimate the risk of a downturn, which can result in significant market corrections. Following such declines, many portfolios experience losses, sentiment toward the market deteriorates, and some investors may withdraw from financial markets altogether. The prevailing attitude of investors, whether optimistic or pessimistic about price movements, is referred to as sentiment. Because the majority of investors frequently make suboptimal decisions in the market, sentiment can serve as a contrarian indicator. Unlike systematic prediction methods that the market eventually assimilates, trading against prevailing the sentiment operates differently for two key reasons. First, it is psychologically challenging to act contrary to both overall market mood and one's own instincts. Second, algorithmic systems also struggle to trade against the sentiment, since accurately quantifying investor mood is not straightforward. However, there are occasions when the sentiment can be measured reliably. To assess sentiment, consider the following approaches. 1. Record your own perspective and that of peers. 2. Collect and document expert opinions. 3. Review the positioning data of CFD traders. A recommended source will be provided in the video description. When consensus across these three sources points in one direction, a clear sentiment has been identified. At this point, taking a position opposite to the prevailing sentiment may be advantageous until sentiment shifts. It is important to note that survey-based sentiment indicators, including tools such as the Fear and Greed Index, often lack reliability due to response biases. In contrast, the positions of CFD traders tend to offer more genuine insights. The sentiment analysis is most effective when applied to broad market indices, like the S&P 500 or Euro Stoxx 50. Although many sentiment traders focus on currency pairs, sentiment in these markets is less predictive due to the outsized influence of macroeconomic variables such as inflation data and central bank policy decisions. Briefly explained, successful sentiment-based trading often involves monitoring extreme bullishness or bearishness and identifying moments when the crowd appears overwhelmingly positioned in one direction. For instance, if an unusually large percentage of retail traders are long on an index and news headlines reflect excessive optimism, contrarian investors might prepare to short the market, anticipating a reversal. However, acting solely on the sentiment without integrating other analytical factors, such as technical levels or fundamental catalysts, can increase risk. It's crucial to remain patient and disciplined, waiting for unequivocal signals rather than reacting prematurely. Common pitfalls include misreading temporary sentiment shifts as lasting trends, underestimating external shocks, or failing to manage exposure properly. By combining sentiment with robust risk management and supplementary analyses, traders can enhance their chances of navigating market cycles effectively.